Fortunately, here I am again about to explain to you how to actually sell puts after I just wasted 30 minutes of recording a video that had absolutely no audio. So, I've already tested, I'll make sure the audio is working, so here we go again. Here's why I personally love to sell puts and why the average put seller loves to sell them as well. So, I'm not doing nothing different that the professionals do. I'm only just being me myself and putting my own twist on them. So, sometimes I'm going to read what I have in front of you. Sometimes you can just read it for yourself. But this is a general overview of why I like to sell puts. And just reading it out loud is cash secure puts lets investors get paid for accepting a defined stock buying obligation with multiple ways to manage your position over time. So it's a lot different than just buying the shares and just holding it. This one you can guesstimate, around what price you would be okay to purchase them at while you still collect the premium, whether it be a lot of premium or a little bit of premium. Regardless, it's all the same. So in this example, we're going to show you cash secure puts, meaning it's already defined. You have the money in your account. You know how much the contract is going to cost. So therefore, you need to have that exact amount of money in your account or more to buy that contract to get paid that set premium. And here's an example that I'm using right now. So this is just a made up stock. The current price at $11. Here's a few, options you can pick from on the chain. Me personally, I'll show you how I do it with supply and demand on my trading view, charting system. And then I'll go into Robinhood and show you exactly how you do it on Robinhood. And then I'll show you what my Thinkorswim account looks like with me actively having some open positions. So let's say you choose a $10 strike price, meaning I'm willing to buy this stock at $10 on set date, which is usually a week to a month to a year out. And I'm going to collect $1 and it's going to cost me $1,000. So everything is times 100 because you need to buy 100 shares at a time. So you're going to collect $100 and you need to set aside $1,000 should the strike close below $10. Even if it closed below at $7, you still got to buy it at $10. So because you already know the defined risk, you get paid up front. So you've already collected your $100 immediately, meaning they put it in your hand right away. So you can definitely withdraw it and go buy something or pay any bills with that $100 right then and there. I would wait before you do that. At least wait until, like, if you're doing weeklies, wait until that Wednesday before you decide if you're going to do anything with the money. And I'll tell you why in a short time. So with it all said and done, current strike price at $11, you purchased a $1 premium at a $10 strike, which costs you would cost you $10, aka times 100, $1,000, and you collected $100. So your risk and your reward is now defined. So here's what can happen if said price does fall below. I kind of already told you you can get assigned, but it's not the end of the world. It's actually a very good thing because I preach this and I always say this to anybody who asks me about this. You only want to do this on shares that you wouldn't mind owning anyway. So whether that's Apple, Tesla, or what I like to do it on the indexes. So Triple Q, the SPY, or my favorite one, the leverage Triple Q, which is TQQQ. So here's an example. Let's say you did the $10 strike. It closed at $8.50 that next week. Because you already collected $100, which is why I say wait before you do anything, your strike price or your average price does go down. So effectively, it went from being $10 to now $9 average price. So after you get assigned, you have two paths, technically three when you get more advanced. So the first two paths are holding for appreciation, which again, you shouldn't be doing this on stocks that you don't care for just because they pay you a lot in premium, because once you do get assigned, you're going to be a nervous wreck. You're going to be panicking if it keeps going down because you know nothing about XYZ stock. So stick to ones you know, stick to ones you can learn to love, and then you won't have no problem getting assigned. And then you can hold for appreciation, like I'll show you what I'm doing in my Robinhood account. And remember, you already collected the $100, so your new average cost is $9, not the $10. This is why I say wait before you spend that $100, because if you do get assigned, it helps. But let's say you did spend the $100, you still already paid the $1,000, so you'll just be at $10. No big difference. You already knew what was going to happen. Now, the other half that people like to do is sell covered calls. Just to tell you real quick, I personally don't sell covered calls, or I haven't yet. I probably will in the future, but right now I don't, because the shares I'm doing this on, I actually want to own them. And I know that since it's leveraged, yes, it can go down just as fast as it can go up, but I like to buy deep under the current strike price. So here's an example of selling covered calls. If I were to sell covered calls, I'll do just like in my example. Remember, you got it assigned at $10. So yes, you'll get paid more if you sell it at a $10 strike, and you'll make the difference from the $9 to $10 since you own it at an average of $9. Or you can sell it right at $9. And if it keeps continuing going up, you still sold it at $9. You made $95 plus that original 100, and you now made $195 on the same 100 shares. Personally, I like to pick a strike that's further out so I can collect, the difference between my average and what I sell at. So this would be a $300 difference plus the $100 already made, so $400, and then plus this 30-cent premium, $30. So total, I would have made $430 on the same 100 shares, assuming the price did rise and close above $12 or at $12. If it closes below, you keep your 100 shares and you keep the premium. So vice versa, if you did do the right at the $9 and it kept going down, you actually made $95 and kept the 100 shares, and you can still do it again. So there's give and takes to both examples. Personally, I still would rather sell out because I am doing it on a stock that's designed to go up. So I want to collect as much premium as I can and collect as much appreciation as I can, and find something that's somewhat in the middle. Now, the reason why I said I probably won't be selling any covered calls is because this advanced strategy right here, which is rolling over. So essentially, you're pushing out the time frame and you're collecting more premium. Obviously, this varies, but I picked something that's more modest just because that's how it'll go. But let's say we had made 10 contracts and the stock was going to close under my strike of that $10. I can push it out one more week, and in this example, collect another 25 cents or $25. And now the strike is at May 17th. There's two routes you can go. Usually you want to go further out and move your strike down. So if you had $10 strike, move it to like a $9.50 strike and collect a smaller premium. That's what this example is. So before you had a $10 strike, now you probably got a $9.50 strike, and you still collected 25 cents on top of that. So now you have a total of $125 in premium that you've collected over these past 2 weeks, and a lower average strike price should it keep going down. So depending on the stocks you're doing with, you can keep rolling over and collecting as long as you can collect a new premium. If you're doing it on shares that you don't want to own, this is another reason why you'll roll it over. But again, there is a big downside if you keep doing this, especially on something you don't like. And it shows you right here. So even with that new $9 or so average strike price, it can keep going down. Now it's below $7 and maybe at $6, maybe at $5. If you still own the shares, that's still unrealized loss. So you haven't lost it yet, assuming the stock can recover. So I'm going to say it one more time. Do this on stocks that you like, that you wouldn't mind owning, and that you already got it at a discount, because remember, you started this when the stock was a lot higher than even $10. So if it does follow, remember, you lower your bases, lowering your cost basis improves your starting point, and that's from the premium that you collected. So the downside is it can just keep going down like the SPY did for the past 3 months. It kept going down to a total of minus 15%, which I was in heaven. I loved it. I wish it'd go down 50% so I can collect even more, which I'll show you on my supply and demand and how I find those levels. So just to recap, before I show you on TradingView how I pick my supply and demand levels, you're already defining your risk with the cash that you have in your account. So if you have $5,000 in your account, which is the sweet point where I always suggest people to start, if you want to do this, the stock that I do, you just pick, the strike prices that are below $50, which would be $5,000 and below. You collect a good premium for you. You collect a good expiration date for you. So for starters, I would say start with 1 month expirations. And then if you're a really busy person, go out to 3 months because you'll get a very high premium and you don't have to worry about, the option for the next 3 months. To me, that's boring. I try to do anywhere from 1 day to 1 week. So let's finally go to my trading view. Okay. So as promised, now let me show you exactly how I find my supply and demand zones, which this says the past, let me see, year. So this is what's been going on for the past year. If you follow, stocks at all, obviously we're just recovered and made new all-time highs in a faster time it took us to go down. So that's why I personally like doing indexes, because I know they're going to recover, at least based off history, since the 1900s. So again, I can't say the same thing for TQQQ because it hasn't been around since the 1900s, but it follows triple Q and the other index. Well, just triple Q, but the same other indexes do the same thing. So if you're talking about SPY or the SPX, it's the same thing. They've been around for an extremely long time, longer than I've been alive. So the first thing I like to do is draw a fib to see at least where my 50% level is and where my 78-ish% level is, and anything in between. So we're going to go from the biggest drop to the biggest new high. So 50% is actually right at a gap. So we have a gap right here. So big gap, that means we opened up, a new day, already up before the week started or the day started. So I'm not going to explain gaps right now, but essentially that just means we opened up higher than where we closed overnight. So my levels are this yellow zone right here is prefer, entries. And then this white zone is, just a 50% retracement from however high it is. Now, when we go look at the option chain, we might not be able to get this low and collect a great premium a week out. Obviously, if you go 2 months out, then yeah, you can pick this low and you'll collect a great premium. So another thing I like to do is pull up the most traded areas. So let's keep this in mind. Let's go ahead and save it, but I'll put it away for now. Here's how I find the most traded levels. I'll pull something called a volume profile, and I'll pick from the start of a horizontal trend to the breakout point. So you can see these volume levels right here. The higher it goes, let me see if I can zoom in. Should have bended this. So the further out these volumes are is the more traded volume, and this green line is the most area traded between these 2 points. And I forgot to mention I am on the 4-hour. Ideally, you want to be doing this on the daily, so it's not going to change, but just to get the whole thing. So still the same. So you have your high point. So this is called the value area high. This is called the value area low. And this is called your point of control. Basically the most traded area between these two value areas. So expensive, less expensive, middle point of expenses. Obviously we broke out and we have multiple gaps. So this is another gap on the daily, another gap, and then the big gap that we identified earlier right here. So now we have multiple zones we can choose from. So just keeping it simple, that's pretty much all you need to do, because when you get to the option chain, you'll see everything else. So if you want to pull a more local fib, you go from the big retracement to the big pop. So just zooming in, now you have a 53 level, 51 level, and a 49 level. It's green for me because I'll love to buy here, but I don't do it right away. This is more so for the day trading. I'll wait to see how it reacts. So it'll probably be something like this. Come down to 50 level. I mean, in a perfect world. Then we shoot up, play around a little bit, close the gap, before we, probably finish going back up. So let's go to the option chain now and keep these levels in mind. Let me delete this. Oops, not that one. So 53 to 49. Let's bring up Robinhood. So, like I mentioned when I was doing the slides, at one point I got assigned at the $50 level, 100 shares, but because I got so much premium before I finally got assigned, it actually brought my dollar cost average to around $42. And all I did was just wait for it to, start pumping, and I just started selling off. So now I'm down to my last 15 shares, which is up, 36%. So this is about $900 right here. But regardless, so here's your strike prices. So you can go out 40 days, 33 days, 26 days, 19, 12. And that's 5 days from today, which is Sunday. So let's do 1 week out. Now my columns are going to look a lot different from yours because I have them customized, which you just go right here. And oh, no, you don't just go right there. Well, I'll show you another time. Yeah, it was right here, actually. Customized columns. So I can show you right here. The columns I have is return on capital, which, return on my capital. Probability of touching, which means how likely your stock is going to touch your strike. And then probability of out the money, how likely it's going to expire worthless. Probability in the money, how likely it's going to expire in the money. And since we're selling puts, we don't want it to expire in the money because that means you'll get assigned or you'll have to figure out how to do rollovers. And then your delta, which is the same thing as your probability of out the money or probability of in the money. And then previous close, highs and lows. So all we care about is the probability of out the money and your delta, which are the same thing. So you would automatically have delta put up, but probability of out the money. So remember my zone. So it was 50% retracement is 53. Ideally, I want to be somewhere right here because it's a good supply zone from where it last took off, and then preferably under the gap. But I doubt I can get a 46 strike and make a good return. I doubt I can get a 49 strike and make a good return. So 56 is paying me $74, and there's a 70% chance that it'll expire worthless. And these numbers will change come Monday morning. So even if you don't know about supply and demand, you can go off these out the monies and deltas. Here's the chart. So here's a good supply zone, basically just where it took off from and where it traded horizontally from. So $55, basically $56, which is paying me $74. So I wouldn't mind that. So let's say you did pick this one. This is a 70% out the money. So just so you can see what it looks like with the delta, it's probably going to be 0.2 or 3 something. So 0.26, right between what I said, 0.2 and 0.3. So the 2.6% chance that you won't have to worry about getting assigned. So 70% chance is what I like. I'll say if you're newer, go back to the out the money and pick anywhere from 80% to 90%. So you can see 90% is paying you $21, but you need $5,200. And then 74% is paying you $62. So I still try to be around $1. So we'll see what happens come Monday, but let's just go with this $74 example. And yes, it's going to take you $5,600 to potentially, well, you collect this $73.96 right away. So let's see what that works out to be weekly. So $73.96 divided by your collateral, $5,600. Assuming it expires worthless and we don't do nothing with rolling over or nothing like that, you just collected 1.3%. And this is 5 days. So let's say you did this every 5 days, which is 4 times a month. That's 5.2% a month, which is around 60 something percent a year. 63% a year. So times it by 100 just so you can see it better. So doing this strategy, sticking around, good support levels, assuming it doesn't expire worthless, which if you get a sign, you'll end up like this where you up 36%. So get a sign. I would love to get a sign. Or you just roll over and you collect more premium like I explained to you earlier. But regardless, think of this as you own a rental property and all it took you was $5,600 to own that property, and you stand to make 63% a year. And let's say even if you did, the lower out the monies, or in the money, sorry. Let's say you did 90%. So you have a 90% chance of never getting a sign, basically, is how I like to word it for that week. So you collect $21. Let's bring up the calculator again. So 2096 minus, because it's minus the fees, divided by that. It shouldn't be 5,600. It should be 52. Oh, there we go. Now it updated. 5,200. So basically a fourth of percent. And again, let's say you did this every week. So times it by 4. 1.6% a year, which is still around 13%. Times it by 12. You making 19% a year. So even still, you're doing better than a rental property. With rental properties, you want to aim somewhere around 10% a year on your cash. And this one's 19% on $5,200. So assuming you collect, $21 average, around 89 to 90% delta. So 0.10 delta, 90% out the money. That's still 19% a year. So I don't know who would be tripping off of making 19%, especially on $5,200. So you can see the more money you have, 19% is still 19%. So if you have 500,000, 19% of that. So obviously you make more on the cash side, but what we focus on is percents. So I try to average 1% a week on the low end, maybe not average. I try to get minimum 1% a week, but I try to average anywhere from 2 to 3% a week because I'm trying to make bigger monies and bigger gains, and I take a lot more risks to do that. But you get the point. I can't show you how to sell cover calls right now because I don't own 100 shares, but it's the exact opposite of what we just did, except you do it on this side of the chart now, which is selling calls. So this was selling puts. If you own the shares already, you can sell calls and still collect premium on the shares you already own. And just to give you another update, let me show you my Thinkorswim account. So everything's still the same from the previous update. Still got that $12,000 because it's still Sunday. The way I have my column set up, so these are all customized because I only care about these numbers right here. Total cost is what the amount of premium I collected. So I've collected a total of $817 in premium. But because they're not all expired worthless yet, they still have some juice in them. I've only collected 55% of this 817, which is $454.56. Total year to date, which I haven't had this for a year yet. I've only been in this account for about 2 weeks, going on 3 weeks. So I've already made $850, which I'm trying to average around minimum $1,000 a week, ideally $1,700. So based on my $30,000 account. So that's a lot. I wouldn't suggest anybody going that big on their account until you understand what you're doing. If you want to copy off the stocks that I watch, here's the stocks that I sell my puts on. So obviously I can't afford to sell it on the SPX because I'll need $1 million. But these are still the ones I like to do. And the reason why I still have SPY up here is because I do, do some calls here and there and probably spend around $50 to do so. But that's not guaranteed. So stick to selling puts for now. Buying calls and selling calls. Buying calls and buying puts are completely different from selling calls and selling puts. We just focused on selling puts only, and I briefly explained how to sell calls when you already own the shares. So that's my rundown. I finished this a lot faster than I did my last video that had no sound. So this is about 25 minutes, and I'm gonna end it here.